Hello all and welcome back to Finominal UK for another portfolio review. In today's review, we're going to be taking a look at Fidelity's multi-asset allocator growth fund, and as we were able to get 100% of the holdings as of the 30th/06/2026, we were able to create this as a dynamic portfolio within Finominal using the ISIN share class shown here for the full portfolio history, and then rebalancing that on the date shown. But to note on the fund manager's strategy, the fund will primarily invest into passive instruments such as index funds, ETFs, and futures provided by both Fidelity and third parties. Summarising the investment policy, overall looks to periodically rebalance back to its target 60-40 allocation. So initially from this summary, you can see it's a 60-40 fund of funds portfolio. Okay. Looking at fund size, quite popular, just over 1.3 billion of AUM, certainly inexpensive as well at 0.2% OCF, and they note their peer group universe of the mixed investment 40 to 85% shares. Now that's interesting to note, as if we head over to the Fund Explorer, looking at this share class ISIN shown here, we can see this is actually a 3-star rated fund within the suggested benchmark universe of the IA Flexible Investment Index. So that differs from that of the fund managers. Reason for this is Finominal will base the suggested benchmark against having the lowest tracking error and highest correlation to that of our extensive benchmark universe, including that of the IA sectors as well. So it's interesting to note that it pulls through that as the suggested benchmark, but it is also worth noting that within that peer group universe, it is a 3-star rated fund. So certainly not the strongest, I will note straight off the back. Okay. I'm going to look to the asset compare now just to show you those two IA benchmarks, as well as a standard 60-40 benchmark and the Fidelity multi-asset allocated growth, where we can see the portfolio we're reviewing has actually underperformed all of the other 3 portfolios shown, so that is certainly worth noting. But in regards to what we will be basing the benchmark off for our analysis, I think given the summarised investment objectives of the fund manager, a 60-40 portfolio makes a lot more sense for this analysis. So without further ado, let's head over to the Finominal Portfolio Analyzer, where I put in that SWDA 60% and AGBP 40% benchmark. Well, let's initially look to the holdings of the Fidelity portfolio, where we can see quite an overlap is what I would say in regards to these holdings, but it could be down to fund manager diversification. So in regards to Fidelity Index World, just under 30%, X-Trackers MSCI World, just under 9%, as well as Invesco MSCI World, 3%. So we've got 3 overlapping global equity funds there, I would say. But again, that could come down to manager diversification. We've also got market cap bets in small cap. We've got 2 small cap global equity funds here from LNG as well as iShares. So 4.29% in the LNG one and 1.8% in the iShares. You've also got just under 6% in emerging markets, 5.5% in global REITs, so real estate there. And noting on the fixed income element, we've got 2 global government bond funds. We've got one from HSBC there, as well as we've got as well as the Fidelity Global Government Bond there, 7.4%. Noting on its corporate bond exposure, so global corporate bonds, 11.1%. And we have also got the same fund from HSBC there, difference being the 11.1% is hedged to the pounds, and the other one just under 5% is unhedged. Okay. But I believe that is all noted now, and also a sliver in cash, 0.9% as well. But now we've noted the underlying holdings, let's continue now with our portfolio benchmarking, where over the last 8.7 years, we can see total return has been less for the portfolio versus the benchmark at 68.88% for the portfolio versus 89.66% for the benchmark, which has given a CAGR of 6.2% for the portfolio versus 7.6% for the benchmark. Volatility has been slightly less for the portfolio at 8.2% versus that of the benchmark's 9%, though we have seen a deeper max drawdown for the portfolio at minus 19.1% versus the benchmark's minus 16.8%. And we have also seen a lower Sharpe for the portfolio, 0.5 versus 0.61 for the benchmark. Noting on dividend yield, 1.52% for the portfolio versus 3.25% for the benchmark. So across every single metric we're reviewing there, we can see the portfolio fall short of the benchmark. Other than that, on volatility, where we have seen slightly less volatility for the portfolio other than the benchmark. Noting on excess returns against that benchmark, effectively from the initial time period we're looking at here, it's underperformed that of a 60-40 portfolio from the start, so that's certainly worth noting. Okay, but let's look now to asset classes and markets, where we can see you've got 53% in equities, 40% in fixed income, 6% in real estate, and 2% in cash. And looking to break down by market cap, you can see 69% in large, 12% in mid, and we're seeing that small cap exposure coming through a bit more there with 18% in small cap, so obviously more than that of mid. But mainly that's market cap in large, as I'd expect to see from those three MSCI World funds effectively. Looking at breakdown by top 10 countries, so you've got majority in the US, 57%, which is comparable to that of the benchmark's 58%. And overall, the numbers here are very comparable to that of the benchmark. Looking at Japan, 6% portfolio, 7% benchmark. The UK, 5% portfolio, 4% benchmark. France, 4% portfolio, 3% benchmark. So very comparable indeed. But the main things worth noting, I would say, is that sector bet in the US, as we expect to see in most global equity portfolios. But let's look to sectors now, where I note the main sector bets being in information tech at 19.7% of the portfolio, as well as financials, 7.5% of the portfolio, and real estate, 6.7% of the portfolio. Strong differences in real estate, with the portfolio having 5.7% higher allocation to real estate, as well as in information tech having minus 4.2% less allocation to information tech than the portfolio. But those are the main bits I would note on sectors for this particular portfolio. Let's head over now to risk analytics, where we can see from a risk contribution perspective, 56.2% of the risk comes from country exposure, so it's got 16% in sectors, as well as 25.9% from idiosyncratic risk. But let's go over to drawdowns and scenario analysis, where if we look from actual returns, we can see the 2022 market sell-off saw an equal drawdown, minus 11% with the benchmark as well. COVID saw a deeper drawdown for the portfolio at minus 12% versus the benchmark's minus 10%, though during the 2018 market sell-off we would have seen a lesser drawdown for the portfolio at minus 4% versus minus 6% for the benchmark. But now, using factor exposure analysis, let's replicate these returns to see how it might have looked during prior periods of stress, where from that 2018 market sell-off, we can overall consistently see from this analysis we would have potentially seen lesser drawdowns for the portfolio than that of the benchmark, especially noting the GFC 2008, where we could have potentially seen minus 13% drawdown for the portfolio versus minus 17% for the benchmark. So certainly worth noting on that, I will note. It's quite interesting to see that as well for a sort of a more concentrated portfolio, though these are funds of funds in fairness. Yeah. So if I'm going to go back now to the asset comparer to conclude this analysis. So overall, it is an inexpensive fund, 0.2%, but we did note it did underperform against both benchmark universe as well as the 60-40 benchmark we created with a lower Sharpe as well. And it is a 3-star rated fund within the IA Flexible Investment Index. So not the best fund I've analysed that is to note, certainly inexpensive, but I think this can certainly be better replicated, so to say, you could say, with a SWDA 6%, AGBP 40%. That's something that's worth noting anyway. But other than that, that does bring me to the end of this analysis. I do hope it was helpful and informative. And if there are any other funds or portfolios you'd like me to review next, please leave them in the comments. But other than that, please like and subscribe, and we'll see you all in the next one. Thanks all.